Let's do this.
All right, what are we, episode 63?
First of all, this is way past my bedtime.
63? I don't even know what time zone this is. I should know.
All right, let's get the show on the road. Let's do it.
Okay.
Kyle, let's go.
Ready?
Let's do it.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 63 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and we are live on location at Limitless Expo. I got my three co-hosts here. They're all speakers. I am not. How do you guys, this first day in the books?
First of all, let me just say one thing. First of all, thank you all for being here. This is amazing. This is the first time we're recording where all four of us are actually physically in the same room. So that's very special. It's
kind of a big deal, right?
It is a big deal.
Yeah.
That's awesome.
And AJ, I appreciate you making it.
Like just now.
Like 5 minutes before. Just classic AJ style. At least you showed up this time. We didn't have to call you. You're like, oh, I'm on a flight to Tahiti right now. But AJ made it. Working through a migraine, so we appreciate you coming.
Do you still have a migraine, or is it gone?
Yeah, we got a lot of drugs.
If I scream really loud, will it be annoying for your migraine?
I got this. I can power through it.
So what do you got drinking then? Did they give you something to
I got
keep you going?
an array of caffeine. We got the Alani, the Diet Coke, and then I'm chugging water. So I'll make it through.
All right, we'll try and keep it relatively short here.
Yeah, let's make this short.
Yeah, Mauricio, what do you got? What are you drinking?
I am drinking a Shiner Bock. Well, actually, that's not true. I've been drinking wine for like the last 3 hours.
Yeah, we started a little early.
I figured I'd switch over to Shiner Bock.
This was thrown together pretty quickly. 3 hours ago, we didn't know this was happening, so we got a little bit too much. Switch to water. We should be okay to make it through the podcast.
But this is a freaking amazing event. I want to get a shout out to Ken McElroy and Tall Yarber for running this thing.
Awesome.
And everybody, the whole team, the whole Limitless team, which is a lot of work, a lot of effort behind the scenes. You guys don't even see it. They bust their butts. So a big round of applause for the team for Limitless.
Jay, what are you drinking?
I'm about a bottle in of red wine, and I've moved on to Pepsi and some mixer. And I know we brought lots of alcohol to give out.
What did you grab?
What was that?
What did you get? What did you grab?
I think this is Pepsi and Grey Goose.
Okay,
I'm wasting the Grey Goose by putting in Pepsi in it. If anybody wants some alcohol, we're not allowed to give it out, but it happens to be sitting over here. Feel free to help yourself. I can't stop you.
Wait, what are these things for? Hold on a second. What's this?
Kyle, you're not wearing a hat today.
I'm not. Like a lot of people have brought that up. Is that a thing?
That's a
AJ,
thing.
you had a bunch of hats, right?
We don't know if you're drunk until
you were
turn
giving
the
out
hat on.
hats.
We
Maybe
need to
someone
get a
could
hat.
grab me a hat from the
Yes,
booth.
grab him
and throw
a
a hat on. Oh.
All right.
There we go.
Closer to the microphones.
Serena, by the way, I gave Serena a job. I thought that would be a fun game. Instead of the top 10, I know Mauricio hates the top 10. We're going to have the top 5 buzzwords, okay? So she went around the audience, asked for some buzzwords based off of our previous episodes.
Oh, we got them.
And I got a list of buzzwords.
Wait, are we doing the top
so
10 in
excited.
reverse? Are we starting the show with the top 10 and then doing our topics?
Whoever says one of these words first, they got to do a shot.
Nice. That's a good
And
rule.
Jay, there's a word on here that there's 0% chance you're not going to say within the first 5 minutes. So. So I was drinking bourbon before that. I had to switch to Michelob Ultra. I got to make it through this podcast, guys. We started pretty early. We got the.
Can I ask a question to the audience? How many of you have never heard the podcast before? Can you show of hands?
There we go.
Carl!
Oh, thanks, Carl.
Oh,
Jeez.
thank you, buddy. All right.
Can't even get our friends to watch it.
Kyle, tell them what this podcast is all about.
This podcast is all about, we started off, Jay and I actually had a podcast, the two of us, and when we came to things like this, we would grab a couple of our friends and we would have a few drinks and we would do a podcast. And we're like, why don't we just do that all the time? So then we called up a couple of our other friends and we're like, hey, let's have a few drinks and talk real estate, economy. Apparently too much politics based on some of the comments in our YouTubes, but we're still going to do it. We love it.
Comments.
So we're going to pick a topic and we're going to argue as much as we can.
Well, so since we're at, jeez, Jay. Since we're at Limitless, and I said these guys are speakers, we figured we'd hit on some of the topics that are going on Limitless right now. We'll start with Jay. Jay, your first panel that you are talking about is how to hedge against inflation and de-dollarization. So you want to tell us a little bit what's going on, what to expect there?
Yeah,
Take a swig.
Have a sip of that.
By the way, did anybody watch the episode from this week where Jay had a couple more drinks than he should have? Yeah, right?
That was a good one.
We're going to try and replicate that this
He
week.
texted me a half hour later, and he's like, "The room is spinning." that's the level. That's the level that he got.
It was a tough night. Okay, so I guess we're talking about the economy, and so we're going to be talking tomorrow. I've got an amazing panel with George Gammon, Jeff Snyder, if Jeff makes it here, and Mike Maloney talking about inflation, de-dollarization, the likelihood of recession. And so I guess a big question that I get a lot these days is, what is the likelihood of recession given where we are? And I think, well, let's start with the likelihood of recession it's 100%. We're going to have a recession. The question is it going to be 6 months from now, 12 months from now, or 5 years from now?
Let's clip that just in case it never happens.
It'll happen.
100%.
I promise you it'll happen. So the question is, are we going to have a recession in the next 6, 12, or 24 months? I think that's the big question on everybody's mind. And I think what it all boils down to is, what is the appetite for the Fed to continue to cut rates? So we know they're going to likely cut in September, at least 25 basis points, maybe 50 basis points. We'll probably get 3 or 4 cuts before the end of the year. We'll probably get down to 4.25, 4.5 by the end of the year. I think that's going to spur the economy. We've already seen some of that priced in. The question is, after the economy absorbs that 3/4 point rate cut or 1 point rate cut, and basically we find that we're still in restrictive territory, meaning rates are still too high. Inflation is coming down and we're still losing jobs. How much harder is the Fed willing to push? Are they going to be willing to cut 1.5 points? Are they going to be willing to cut 2 points? Are they going to be willing to cut 3 points? Are we going to see rates come down to 3% or 2%? That's the big question.
Where are you getting these 3 rate cuts from?
None of those.
Like, where's that coming from?
No.
Well, so
No,
I'm fact checking him. So actually, he's not far off. So 45% of the experts agree that we're going to be between 4.25 and 4.50 in December.
3. How many people think there's going to be 3 rate cuts this year? See, nobody agrees with you,
Well,
Jay.
we got
But
one.
it doesn't have to be 3 rate cuts. It could be a 50 basis point cut and a 25 basis point cut.
Right.
It could be 325s. It could be 175. 75 point basis cut, whether it's done at all at once or 3
planning on
times.
2 cuts. And they said that they seem likely that it'll be 2 cuts. We'll see how much they cut. I think that's the question. You're right.
We're priced in at a point cut by the end of the year.
So, that's
No chance.
And that's the odds-on favorite.
No chance.
When I say 45%, there's only 28% that say that we're going to have 450 to 475. There's actually quite a few. There's 23% that believe there's going to be even more.
We talked about this in a prior episode.
Yeah.
What are the odds of them cutting rates during an election cycle? Like, I understand one rate
so
cut.
he'll do
100%.
He'll think he's going to do a quarter now, but then right after, like, all bets are off, right? He doesn't have to worry about an election cycle. We still got.
You're talking about like November. Okay. All right.
Here's the problem. A quarter point's already factored in. We saw the market up 400 and some points today. We've seen the market up about 600 points over the last week since the Jackson Hole speech, where Powell basically said, it's time. We're reversing course. And we've seen the market spike. So that quarter point or half point cut is already factored in. It's already priced in. And so if we only get a quarter point cut in September, the market's probably going to react negatively. The market's expecting something bigger. And if we get a quarter point in September and we don't do anything in October, well, then we're going to see a really big negative reaction by whether it's consumers or businesses, whether it's investors. So I think the Fed's going to have to cut in September. They're going to have to cut in October. And if they do a quarter point in both of those, they're going to have to cut in December. I'm going to bet 3/4 point before the end of the year. If it's not 3/4 point, I'm going bigger. It's at least a point.
Was this
Zero
a predictions
chance.
episode? He's putting the prediction. So
He's been wrong in every other episode on the prediction. So
Do you disagree?
I don't think the Fed knows what the hell they're doing anyway. So I think they're clueless and they're going to react to whatever's going on.
So by the end of the year, how much are we going to see?
Who knows? Like if the stock market has another episode like it did in August, and we have a disorderly reduction and crash in the economy, they're going to cut.
I don't think they care about the stock market. They're more worried about, like, when we saw that 4.3 on the unemployment. I think they're more worried about that. They're worried about, we've seen a few months in a row unemployment still up, and if we start getting on the other side of 4.5. They're going to panic, and I think that's when they hit the panic button.
Didn't we lose like another 800, 900,000 jobs last week?
Well, the revision, we talked about that in length, though. I took my victory lap that I called that, but That's fine. So AJ, what do you think? Do you think how many cuts?
It's an
And do you think that's
election year, inflation, jobs. Jobs, if it stays steady, they're going to continue on course. Outside anything major happening, they're not going to do anything outside their guidance because it's an election year. After the election year, depending on jobs and if inflation is budged, even if jobs rises though, and we do not see lowering core inflation, and it is priced in and we're still not seeing it, they're still going to be hesitant.
Keep in mind, this isn't like if we cut rates, we're not stepping on the gas. We're just easing off the brake, right? Like
Well, it depends on how much they cut.
Well, true,
Yeah.
but even if they cut a full point, that would still be in restrictive territory. So we still technically wouldn't be in the point where we're
look at what happened
fuel on the
just when
fire.
they mentioned it, though. 8 months ago, what the markets did and what inflation did. So we say it's in restrictive territory, but that's only off the basis of the last 10 years. Restrictive territory off the basis of a 3%, maybe, but
I'm going based off of what they believe neutral rate is.
that's okay. Yeah, that's true. But no matter what, being an election year, they're going to be hesitant to do anything major. And so they're going to follow the guidance. They're going to cut. They've already stated that. We know they will. Quarter point is a give me. They may go higher than that. Jobs and inflation. But if we see 3%, they're not going to be.
So you touched on that though, inflation. So if we see jobs, unemployment continue to rise,
Yeah.
but the inflation
Rise is okay, but the rate at which it rises is what they're going to look at.
right. But the
A big
inflation, if we
spike
don't see
out of
any
control.
progress in inflation, which one of those two mandates? I'll ask Mauricio. Which one of those two mandates do you think they're preferring right now? The jobs or the
I think inflation for
Inflation.
sure. So inflation,
Inflation
and my-
all day long.
And my biggest thing with inflation, I talked about it last week, but I'm going to hammer it again, is like even though official inflation numbers are coming down to the sort of the target 2%, when you look at what
Housing.
most families have to spend money on is what? Housing, which is up. What is that up? Freaking AJ, like 50%, 30%.
Crazy.
Food. And energy's like, you go to the gas pump, it's probably about the same. It's not a huge thing. But when you look at their housing costs, which is usually 30, 40, sometimes 50%, and their food, the average American's
too squeezed.
personal inflation is way above 2%. It's more like freaking 10,
Inflation
15%.
affects everybody. Jobs affects the percentage of people that lost their jobs. Inflation can rear its head. They don't want a Paul Volcker situation. If they leave and they don't go through the crap, and they don't, and they're too skittish about it, and they pull off, they could see it roar back. If it roars back, they're in a much worse position. They'll let people lose jobs if inflation's
to what
not
point
coming.
though? I guess it's like what
Once
level
again, though, it's who you're affecting, because we say that 3 or 4% isn't very high. It's not very high, but it is off of what we've already gained. So we do not have increases massively in jobs. It's not outpacing it. And you're talking about 100% of the population that's being affected by it. So if you have jobs or unemployment that's at 5%, right? Yes, you have that unemployment at 5%. But if inflation starts creeping back up, you're crushing the 100%. Inflation, you get riots from inflation. You have upheaval over it. And during an election year, they're not going to be playing with that kind of stuff. So it will be on the back burner. If you saw inflation really come down and then unemployment starts to spike, that's when they get scared.
Well, we talked about this last episode though, but like 2%, is that a real number? And we said that Powell's probably kicking himself that he threw that number out as a
right now
flat
it's not,
number.
because it's much, much higher than that.
A range would have been better, like between 2 and 3%, they would have already achieved it, right? Like there's no.
But closer to 3%, along with these other factors, that's way too high.
So I think, I hate to say I agree with you guys, but I agree with you guys between the two mandates. So the Fed has to decide, are they going to focus on inflation or are they going to focus on jobs? I agree they're going to focus on inflation, but for a different reason than you guys say. And the reason I think they're going to focus on inflation is because inflation is going to be driven by interest rates where they are today. Yeah. And the Fed's going to lower rates. Lower rates is going to help jobs. But here's the thing. If jobs don't correct themselves, if we keep seeing unemployment tick up, if we keep seeing job losses, if we keep seeing layoffs, they can always drop rates. But if we start to see inflation tick up, there's 0% chance the Fed wants to start to increase rates again.
Exactly.
They don't want to get
in that position.
Right. They're starting the decrease cycle. They need to stay in the decrease cycle, because if they have to do a single hike during the decrease cycle, that's going to scare the market.
So is that another reason why you think a recession is inevitable? Because they'd rather have a recession
want a
hit,
recession.
and then they could drop rates than have inflation run away.
The Fed wants unemployment. The Fed wants a recession. They're not trying to avoid a recession. They're not trying to avoid unemployment. They have to have.
I mean, the markets don't necessarily agree with you though, because the only time if you look at when the markets go crazy, it's been on these jobs reports, right? It's jobs reports. That's when when we have an inflation print that's a little bit higher, a little bit here. The markets don't really seem to react as much as if we have a bad jobs report, then they start to freak out. So that would indicate to me that that's what they think is more important.
But you're talking about two different things, because the Fed, they are in charge, right, of inflation and commodities, Main Streets, prices, everything else. The stock market, earnings, right, layoffs, all of that. These are.
I'm talking like treasuries too.
So here's the thing everybody's ignoring. What is a recession? Why do we have recessions? We have recessions because for 3, 5, 7, in this case, 12 years, 14 years, we're seeing debt levels increase. Mm-hmm. We're seeing personal debt levels. We're seeing corporate debt levels. We're seeing government debt levels increase. And the whole purpose of a recession is to roll off that debt, for there to be bankruptcies, for there to be foreclosures, for people to basically not be able to pay their credit cards, for people not to be able to pay their car loans and lose their cars. That's what a recession is. It gets rid of that debt and it creates a reset. And the Fed knows that at some point soon, we're going to have that reset. We're going to have to roll off some of that debt, because if we don't, real estate prices are going to keep going up and people are going to be priced out. And we're going to see business issues and we're going to see inflation issues. And so the Fed, I agree with you, AJ, the Fed wants a recession. But here's the thing. The Fed has been very, very careful about not pushing a recession near the end of a presidential term. Yes. Because they don't want to be accused of being political. But the nice thing is the typical recession lasts 12 to 18 months. If the Fed were to induce, let's say hypothetically, a recession within the first 6 months of a new presidential term, that recession statistically should be done within 18 to 24 months of that presidential term, which means by 2026, 2 years before the next presidential election, we're in the next phase of the cycle.
So do you think that's why Powell was so dovish at Jackson Hole? Because he was like, hey, if I just say that we're going to be doing rate cuts, that'll kind of keep everyone spending, that'll keep the economy going for long enough to get us past this election?
Yeah, but here's the kind of funny part, actually, when you think about it. When the Fed started raising rates, everybody talked about they're trying to get asset prices down. They're trying to bring the real estate prices down. They're trying to bring, stock market price down. They haven't succeeded with any of that stuff. Like, if you look at real estate prices from the time they started raising rates, at least in single family, where are they today? They're at an all-time high. Stock market, basically an all-time high. So they've completely failed in their goal of raising rates to get the demand down. And now they're starting to talk about reducing and cutting rates. They haven't even succeeded in getting housing pricing down, stock market down.
Yeah, but that's not their mandate. They have no...
They want asset prices lower. That's why they started raising interest.
But they have no control of... The reason asset prices are where they're at, one is because so much money's been printed, but number two, it's because the dollar is so strong right now.
It's because interest rates aren't high enough to clear the market. It's not high enough anymore.
No, there's so much liquidity coming into our market from other economies because the dollar is too strong.
Well, we talked about this. But we have $4 trillion.
I mean, but you have to recognize it. The fact is, we have higher interest rates than any economy, any market on the planet. So we have money moving from...
And we have the best economy, too.
And we have the best economy.
Well, so interest rates in other markets are much higher than ours.
Well, okay.
No. Interest rates are?
Yeah. South America, 10%.
I was going to say, if you want to talk about...
Check that Zimbabwe.
Turkey.
You know what interest rates in Turkey are?
Well, no, inflation's higher. But, I mean, I'm talking about developed first world countries.
It's about real interest rates.
You're talking about,
you could get a great interest rate in Russia right now.
I'm Turkey.
Turkey's got some pretty good. Argentina's getting a little lower, but Argentina.
I told you that though. When I had my money, when I lived in Russia, they were offering 17% interest rates to keep your money in the bank because everyone was.
Do you know what the best stock market was to invest? Like not too long ago, Venezuela. Venezuela's stock market was like doubling, tripling, quadrupling.
They had 800% inflation.
Yeah, well then it's gonna exactly. It's gonna go down to 800% in 2 weeks probably too. Yeah. You got to ride that wave.
But the problem is the only thing at the end of the day, they're trying to contract money supply. They can't do it. We printed trillions and trillions of dollars. We print $1 trillion every single 100 days still. So they're trying to reduce the money supply. That's all you do. Interest rates up, money supply contracts, demand contracts, unemployment goes up, recession happens, everybody
Banks
wins.
stop lending
That's
because
what they want.
demand goes down.
They want unemployment. They've said that. They got in trouble, not in trouble, but the media went after him because they're like, you're causing unemployment. You want unemployment. And he's like, yeah. But when you, at the end of the day, we have money coming in. We printed, it's easy to print money. It's really hard to get rid of it. It takes time. They printed so much, so fast. We have so much coming in that the high interest rates, even at that length, we haven't had defaults. You get rid of money through defaults. You don't get money because people burn it. We haven't had defaults. So the money supply isn't contracting. If you lower interest rates on top of a money supply, it's throwing gas on a fire. So they can't just drop interest rates. They have to be very, very careful. They're trying not to rock the boat through election years. It's going to remain pretty steady.
And as I said, though, they could still lower them and stay restrictive, right? Like
Yes.
like who's to say that they had to stop at 5.25, or like why couldn't it have been 5? Like going from 5.25 down to 5. Like what's really the difference of the effect of the market? We're still very restrictive.
We were listening to Robert Kiyosaki earlier today at the luncheon, and he said the same thing we've been talking about, which is like he was talking 90 days, $1 trillion printed every 90 days, and he put a nice number on it, which was like it was like $33,000 a day. That's how much money we're printing. 33 and change, whatever it is, a day.
Million?
No, 33 million.
Per day.
Yeah,
Per day.
million.
33 million. Sorry, $33 million per day.
Yeah, AJ makes $33,000 a day, so that's not
true.
a big
That's
issue.
true.
Yeah.
That's true. That is true.
So, I mean...
Wrap this up?
Yeah, just to wrap it up, here's my prediction. I think the Fed is...
Wait, this is a prediction show?
No, but I'm going to make
It's just the J prediction show.
This is just a J prediction
He
show.
gets in front of an
Every
audience
show.
and he wants to show up.
No, I'm always willing to make a prediction. Worst case,
Do you want to make a right prediction for once? Or?
I'm going to try.
All right, cool.
So the Fed is willing to drop rates. I don't think the Fed is willing to go below 3.5, 3 3/4. I think they think, and if you look at the Fed dot plot, 3.5 is probably what they consider to be the neutral rate. They're guessing. We're all guessing. I don't think they're willing to go between 3.5, 3 3/4 for the federal funds rate. If we get down to that amount, and I think they're willing to lower it to that amount, they're hoping that that'll be enough to kind of keep things moving. But if we get down to that amount and jobs continue to spike and bankruptcies continue to spike, I think they're going to be okay with it.
I'm going to channel my best. I'm so bummed that he wasn't here today, but I'm going to channel my best Jeff Snyder quote. I mean, Jeff believes, and I totally agree with him, that the Fed really doesn't have any control of any of this stuff. They're really reactive more than anything else. The market is going to dictate where interest rates are going to go, and the Fed is going to react to that. And I think the interest rate, the market is driving interest rates lower, and the Fed is going to react to that and drive their Fed funds lower. But it's not because they want to do it; it's because that's what the market's going, and we're in that cycle.
That's all the Fed does.
Mark my words.
Jay, you don't need to get the last word every time.
I'm going to say this. For whoever wants to hear people smarter than we are talk about this tomorrow, 8:30 a.m., I will be moderating a panel. George Gammon,
with really smart people.
George Gammon, Jeff Snyder, Mike Maloney. We're going to be talking about this. We're going to be talking about inflation. We're going to be talking about de-dollarization. We're going to be talking about where the market's headed. And
a plug for the event. I think if you're not here, you can download the videos afterwards, right? You can buy
and
the
they're
videos.
going to agree with me.
Yeah. All right. Nate's over there. He's supposed to intro us, and we couldn't find you.
Nate finally shows up at the event. Like Nate is like been. Where have you been, Nate?
All right, thanks, man. All right, let's move on. So we're going to go to Mauricio's panel. So Mauricio is on a panel about how to raise money in today's market. Obviously, it's a bit of an uncertain market, and you got a great lineup here. You have Ken is moderating. You have Robert Helms, Kathy, Brandon, and you. So let's talk a little bit about what you believe that panel is going to be about.
I don't know how I got on that panel. Like, it's an amazing panel. I think it's on Saturday morning, but we're going to talk about how to raise money in today's market. And as if you guys know, it's very, very difficult for most people to raise money in today's marketplace. But what's really fascinating, I think we're going to talk about this a lot, is to give a lot of props to one of our hosts, Ken McElroy. Kenny and his company, literally, is he around? I want to give props to Ken. I want credit for this.
He left.
Ken left. So Ken literally just raised $48 million for his latest offering. And so the question comes up is like, well, why is it somebody like Ken, or actually, to be honest with you guys on this panel, why is it they can raise a bunch of money and other people are struggling? That's a really good question to just think about. And that's, I think, what we're going to be focusing on tomorrow. Like, why are some operators, some syndicators able to raise tens of millions of dollars and other operators are having a hard time? And I think it goes back to what we've been talking about for quite some time, especially from the LP perspective, which is people always get enamored with the deal and the returns and the IRR and where the property is and the actual returns. And they're like, hey, this project's returning 25%. This project's only returning 21%. So I'm going to go with the 25%. When at the end of the day, the quality of the operator, the quality of the person or team that's raising the money is really what matters the most. And so we've been harping a lot actually on this pod, especially for LPs when they're trying to figure out where are you going to put your money. It's always asking those questions of like, hey, who is the team? Who are the operators that are actually executing? Am I screaming loud here? Oh, am I close to one of the buzzwords?
You're close to the buzzwords. We're waiting for it.
So all of the questions that LPs should be asking is, I think, the reason why some people are struggling with raising capital is like, how experienced are these folks in actually raising money for that particular asset? Like, if you're like AJ here is one of the best self-storage guys in the world. If you're not a self-storage guy, what's your experience in raising money for self-storage? Like, AJ's been doing this for a living. Jay and Kyle have been doing multifamily. So if they started trying to raise money for mobile home parks, you got to question whether they're able to do that. So you've got to figure out what is their reputation, what is their track record, and what is their trust. One of the biggest things I've really been harping on, because I'm a syndication attorney, so I represent syndicators, is a lot of syndicators are literally putting their head in the sand. They're sticking their head in the sand. They're not communicating with their LPs. They're not telling them what's going on. And I think that's affecting LPs' decision on who they're going to invest with. They want to invest with people who have the track record, who they can trust. Kenny always talks about, communication builds trust. And I think the more and more people can trust you, know that you can pull off the deal, that's what really makes the difference between somebody who can raise the capital and somebody who cannot.
And I want to throw out two things. One, that trust doesn't just come from knocking every deal out of the park. I mean, it's great if you can knock every deal out of the park, but most syndicators are going to run into situations where something happens, where they don't hit their returns, or they have a capital call, or worst case, they lose a property. Can you still raise after that? Absolutely, because you can still build trust through bad events. And the way you do that is through transparency.
There it is. Buzzword, transparency. I got to get a shot for Jay.
Transparency.
Okay, that's like 3 more shots, right?
And communication. So seriously, you have to be transparent. You have to communicate. I've delivered bad news to my investors before. And when I deliver bad news to my investors, generally the reaction I get is thank you. Thank you for being completely transparent. Thank you for not making me wonder what was going on. Thank you for not waiting 6 months before you told me what was going on. So you can build that trust by being transparent and by communicating. Here's the other thing that's really, really important. We all think about raising money from our perspective. We all think about, we go out, we find an amazing deal, and then we go to our investors and we say, you should invest in this because I'm telling you this is an amazing deal and you should invest in it. But the reality is, that's not the reason most people invest. The reason most people invest is because the deal meets their needs. It meets what they're looking for. There's $300 billion sitting on the sidelines right now in dry capital. The money is out there. There is a lot of money. There's more money out there than at any point in the 16 years I've been investing. The key is I need to find the deals that will get my investors to say, that's the deal I want to invest in. And I can't guess what that is. I need to talk to them. And I work really hard every month to send out a survey and to say, hey, what types of deals are you looking for right now? What location? What type of deal? What exit strategy? What class of property? What type of return? What's your hold period? I know the exact type of deals that my investors are looking for because if I know that information, if I find that deal, I know the money's coming to me. If I go out and find any deal, any random deal, and I say to my investors, hey, come invest in this guy, I think it's a good deal, some of them might. But others are going to say, well, it's not the location I want. Others are going to say, it's not the asset class I want. Others are going to say, that's not the hold period I want. Others are going to say, that's not the return structure
But
that I want.
you got to get them to the point where they trust you at that point too, right? Because anyone could put numbers together. Anyone, like you could look at an underwriting spreadsheet and I can list you 12 different ways you can pull levers and make returns look better. But they have to trust you that you're pulling the right levers and you're doing the right thing. Yeah. And once they get that level of trust with you that you have their best interest at heart, then they can look at the numbers because it's not apples to apples, right?
That was the first part that was the first part that Mauricio said.
Right.
You got to trust your operator. This is the second part.
Right. Because it's not apples to apples from one operator to another. One operator could be like, hey, I'll give you 17 IRR on this. We'll underwrite the exact same deal and we'll be like, hey, we're coming up with 12, even though it's the exact same deal.
And two, we don't. So a little different approach. I don't compete on like what the individual investor is like. We have a strategy, and this structure works within this strategy, and there's reasons for it. And so when we're coming out, we're showing the alignment and how we're doing it. So I think I don't know if maybe the market's changing or not, but we've had probably the most successful last 2 months that we've had with our firm. We raised tons of money.
Like raising money or
raising capital. Yeah. Oh yeah. We've done this year. We did. Last 2 months we've gotten over 20 million. The last 3 weeks alone. And so I think but a lot of it.
AJ's got his whole team.
That's right.
By the way, I'm supposed to. I forgot. I was going to do it at the beginning. I'm supposed to give you a little bit of shit. I've been talking to your team.
Yeah.
And we've been calling them your assistants, and you've just been going along with it. And they're not your assistants.
Oh, I know. They're not happy about it.
They're
They
team.
hate-
They're
they hate-
Are
actual
they
team
like the
members.
COO?
Yeah.
They're like
they
some
hate you all.
of them have like a name of like director of something. And
Well, we do have like, according to you guys, it's like 50 assistants, or
I
is it
don't know
like
if you guys
50,
know,
is
but like
86
AJ has like 37 assistants.
37
And we're
today.
always wondering
It
whether
always
assistant
changes.
number 4 or whatever.
Yeah. But when we look at it, it's first of all communicating the reality of the situation, right? Where it's like, no, markets suck. We're not trying to, say that it's not what it is. Here's our advantage. Here's our strategy. Here's how we've done it and what we're doing. And this is why we're doing it. And really sticking by that. And I think that right now we see capital that is wanting to be a little more opportunistic. It's like over the last year, I think the capital has been really, really nervous. And from what I'm seeing, we're starting to see capital thaw out a little more, where I think they have a better idea that, okay, interest rates may have peaked, right? We'll still have pain, but there's a light at the end of the tunnel. I think that's really important. And when you look at it,
you think that has anything to do with treasuries coming down?
I think it has to do with a lot of things. I think it has a lot to do with the Fed statement, treasuries, but I think also it has to do with what people are just seeing and feeling, like their day to day. I think that a lot of people expected real estate last year to collapse. Like there was a lot of people that were just like, this is all going to end. Now, all of us in real estate know, first of all, the last 2 years sucked. Our investors were calling up and they're like, are we going to get a capital call? And I'm like, why would you think that? No, we're not doing it. And they're like, well, I'm getting capital calls all over the place. So understanding where they're coming from is really important because they're experiencing these things, right? And a lot of investors, and a lot of operators, we're all getting burned, right? We have been. So like Jay said, just because you've been burned doesn't mean you can't raise capital, right? But you have to be honest about why, what happened, what the approach is in the given circumstances and changing. And I think people are willing to give money right now. I really do. I think they're willing to be more opportunistic and to say, I get it, times suck, that's okay, right? And I understand there's gonna be pain. Like we tell people, when are we gonna get cash flow? Don't expect cash flow in the short term at all. That's not how this is gonna work. So we're trying to really stick by. This is the track record. We're sitting here going, we haven't lost any deals, no capital calls. We've done this way, and this is why it works. And sticking just to the facts, the simplicity of it, and that I think that works in today's market. You just be like, this is what's going on.
So on that note, I want to one last question before we move on is that we've luckily been able to avoid any capital calls. It's when you say, okay, it hasn't been like we've seen commercial real estate has gone down 25%.
Yeah.
So like whatever word you want to put on that, that's a significant downturn.
Yes.
And so there are capital calls
commercial
happening.
real estate's been in a recession. It's
Right.
been the hardest hit part
Right.
of the
So
economy
real
last
real
year.
estate, there's a big difference between single family real estate and commercial real estate.
Big difference.
So, but I'll put it back to Mauricio since this is your topic. for operators who have had to do capital calls, do you think that's a death knell for them for raising capital, or do you think?
I think it's the way they handle the situation. Like, I would implore every single syndicator, especially real estate syndicators, that if they're going through hard times, and look, we're all going through hard times, to just over communicate with your investors, because, like I said, communication builds trust, and they're going to understand that things aren't going well. Like, they understand that the interest rates went up ridiculously fast. They understand that the cap rates can only go so far. But you've got to communicate with them, and they're going to be investing money in the next cycle, and they're going to be investing money with people that they trust and who've handled the situation better. So if you're out there and you're sticking your head in the sand and not communicating with investors, not talking to them, not letting them know what's going on, you're going to have a much harder time raising money in the future versus someone who either hasn't had an issue, or even if they have had an issue, they've actually communicated with investors, let them know what's going on. I think people understand that things are tough, but if you just stick your head in the sand and don't communicate, the chances of you raising money in the future are zero.
Well, I think it's even the opposite, that people understand that it's tough, what you're saying, because like for us, I did a really bad job. I didn't understand what they were going through. So they had all these fears that, to me, not that they were discounted, I didn't understand them because we weren't having them. Right? And we're like, why would you be afraid that there's going to be a capital call? Like, no, what's going on? So I wasn't putting myself in their position. And I wasn't understanding where that necessarily was coming from. So I wasn't communicating to it. Why would I communicate that we're not having that when I didn't even think of it, right? So I think it's really important that not only you communicate them to that, but you also communicate to the market. You also communicate to what they're feeling and how they're seeing. And you do that, like Jay said, and Jay's good about this, by really reaching out, surveys, figuring out. Then you can accomplish both of those methods.
And also, can I give a shout out to, because you mentioned that Jay you guys do a really nice job of surveying your investors,
Really
like
nice
literally
job.
sending out polls to say, hey, what are you guys looking for? Are you guys looking for safety? Are you guys looking for a return? Are you guys want to be conservative, aggressive? You actually poll your investors, which a lot of folks don't do. So maybe you want to talk about that.
Jay takes every investor out to a steak dinner. He told me what. So if you're listening,
cigars,
every single one.
Yeah.
Which, by the way, every survey Jay puts out, I respond to it with a fake name, with something funny, and then just to see if he picks up on it.
Let me throw out another thing. It's really important your investors look to you to educate them. They look to you as the expert, and don't take that responsibility lightly. One of the things that we do at our company is, and maybe we have the ability to do this because we don't have as many deals as AJ or a lot of people out there. So when we have a handful of deals, a half dozen deals, every quarter we have a Zoom call with our investors. We do a separate Zoom call for every deal that we have. We invite the investors. We do a half-hour presentation, the good, the bad, the ugly, all the financials, and then we open it up for questions. And we use that as an opportunity to educate our investors, not just on what's going on with the deal, but what's going on in the market, what's going on with our company, what's going on in the location where we're at, because our location, we're going to see different things than other locations. So use that as an opportunity. Another way to build trust with your investors isn't just to be transparent and to communicate, but to educate. If your investors look at you as the expert, willing to educate them, they're going to come back over and over and over again, because people like to invest with experts.
All right, let's move this along. And by the way, AJ, I have to say you're crushing it this podcast. For someone who showed up 5 minutes before we were going on stage, we were a little bit worried. We're talking with your team. We didn't know how prepared you'd be. You're crushing it, man.
Were we talking to the team or the assistants?
I have to be careful since they're here.
You're going to
Once I get back in Philadelphia behind my little computer screen, I can go back to calling them assistants. But
yeah, people that are executives and partners don't normally like being called.
What you have to realize, most of AJ's team owns guns too.
Oh yeah, we're in Idaho.
When you go by his office, like, they'll be showing off their guns to each other during the breaks. So you got to be careful with that. All right, so we'll move on. We'll finish this off, AJ. So your panel that you're going to be talking about is recession-proof businesses. And so we talked about this before, how a lot of real estate investors are actually pivoting a little bit to buying businesses. Yep. We're even seeing some people syndicating businesses, which is an interesting concept that we're looking into. So what do you think that panel is going to be about?
So I think this is a really interesting topic for a few reasons. As the public and capital sways, first of all, it's like it can sometimes be the tail wagging the dog, Let me put it that way, right? And I think you got to be really careful not to just jump on a trend, because the problem that most people don't realize economically is when you identify the trend, the opportunity is always gone. So like when we talk about it, I'm like, the best time to invest is when you think everything's going to fail. When you think it's going to be successful, it's priced in. It's gone. So like the best investments we ever did was in 2008 and 9, when like people are like, oh, well, yeah, I wish I could have invested in that too. Like, you don't understand. When we were investing, we thought it was going to fail. We're like, this is going to be a decade, right? It was so miserable and so bad. So first things first, to say a recession and recession-proof, there's no such thing as that. It does not exist. People say that about storage, and I lose my mind. And I have.
What about a friend of ours owns a liquor store? Isn't that pretty recession-proof?
And nothing is recession-proof.
It's called recession-resistant.
Recession at best. And two, the second thing is the moment you add in debt, now it is not only is it not recession-proof or resistant, it's actually more sensitive to recessions. Why? Because guess what happens when you have markets that go up and down? You have the government get involved, you have Fed policy change, and you don't know what they're going to do. The moment you add in debt, you take a model that may be recession resistant, that may be a great hedge against it, and you turn it into one that's not. So there's a few things going into it. People are looking at opportunities and things that are recession resistant. Usually all you're talking about is a shift in the customers and what they need. So like lots of times recession resistant companies aren't recession resistant. They actually just perform better in recessions. And so the demand rises. That's actually when they do good. It's not a recession for those industries. So they're not recession resistant because in boom times, they actually suffer. That is their recession. Each industry performs differently. So if an industry is booming in a recession, it doesn't mean they're recession resistant, because all of a sudden when lower interest rates go up or interest rates go down, that company actually may fail when the economy is booming. So you got to be very careful, first of all, how we classify it. At the end of the day, people are trying to buy businesses that are a hedge against today's market and against today's cycle. That's what we're talking about. And I think they're looking at security in cash flow, not equity. Almost always when I hear people talking about recession-proof, recession-resistant, it is the consistency of cash flow,
So
not equity.
what produces consistent cash flow these days? What businesses produce those cash flows?
Well, that's why real estate investors, I think, are looking into it right now, is because we're comparing it to cap rates, right? Like as commercial real estate, like cap rates, and we're still paying in the 5s for cap rates. So it should be 5%. Well, our loan is that much, right? Like our loan rates are the same as that. So like cash flow right now is very hard to come by, especially if you're doing any kind of value add, and like you're basically getting no cash flow. So us as real estate investors right now, like we're still investing for the long term and equity plays and stuff like that, but cash flow is thin.
Dead.
Especially when you're comparing it to, you could get basically risk-free cash flow at 5%, putting it in treasuries or money market accounts.
Back when interest rates were zero, and you could get a loan for 2.75, and you were buying it at even at 4 cap. That's why things were at 4 cap. You could make the spread, right?
Spread was good.
You could take the delta, and so cash flow was great back then. Well, now we're in the opposite situation. So investors are out trying to look and say, what's a way that we can get cash flow? And if you look at these
They're
businesses,
starving. They don't have investors. They don't have new deals because deals don't pencil, and they don't have cash flow. They're starving.
Right.
But they're starving because their baseline is 5%. I can put my money in money market account and make 5%.
But if you look
So
at business,
why would I put money in a business at 5.25 or 5.5 or 6 when I can get 5?
you can buy a business for like 3 times
2x,
income.
33% cap rate.
Right,
Yes.
exactly. And so
Or less.
So
A
us as
33%
investors, we're
cap
like,
rate, 3x is high.
shit, we know how to run a business, because like buying an apartment complex, that's not buying real estate.
Yeah.
You're buying a working business. We know how to run a business here. How hard can it be to do this other
Famous
business?
last
That's
words.
famous last words. That was just what I was going to say. But the point is like when they're looking at this cash flow, they're like, oh, that's pretty enticing.
So
You know what's a really good cash flowing business to buy? Is a law firm.
Except you have to be a lawyer.
Do not buy a law firm.
And you have to work in the
You
business.
are not
Anybody want to buy a
attorneys.
law firm?
Do
Anybody
not
want to buy a
buy
law
his
firm?
law firm. Nobody buy his law
Real
firm.
estate investors don't want to actually do
No.
work in their business. They want to buy it, set it up, and forget about it.
I think a perfect example of this would be, I just bought a company that's in the hunting industry about a month ago. it has core products. There is a differentiator. But
What do you-
when
we're
I
not
What do
gonna
you
talk
kill?
about-
Who do you kill?
No, don't
What do you kill?
bring this up. My wife's going to
You say you're
boycott
hunting.
us.
You kill bunnies?
I guess some people probably kill bunnies. I mean, people hunt for everything.
If they ask
So-
for it.
Yeah. So, but they do this preservation stuff. But when you look at the different industries, and especially industries like the hunting industry, for example, demand is fairly consistent through different cycles. So you look at products that people either participate or they need, regardless of up and down markets. In fact, in lots of situations, hunting actually increases during those times. And so when you look at recession resistant, you really get back to a core. You get rid of excess and you get back to a core. And normally core demand products can be commoditized and they're more localized and they're simplified. Now, the problem though with a lot of those things is your valuation is predicated on two things only. You can increase cash flow or you can secure cash flow. Nothing else. Meaning that if I'm making if I have a 10% margin and I increase it to 20%, I have effectively doubled the value. Or if I say that 10% margin can't go away, it is now guaranteed for a decade, you've now increased the value of it because you know what's going to come. So when you look at businesses, you don't have that guarantee. You can increase it sometimes, but recession-proof are much more secure. So they actually trade a lot of times at higher multiples. They can be way more work though as well. So you're going back to core demand, and core demand is around basics. Think about like food. Food is one of the most commoditized things, low margins. They trade really high though, infrastructure-based stuff. They're usually not monopolized, but there's a monopolistic principle about them, meaning they have territories and they're simple things. So those are the kind of businesses that people look at. Consistent cash flow, the basics, secure of that cash flow. They're usually regional. They don't have large fluctuations, but they also will trade at a higher multiple. If you're buying a law firm, you're trading at 1.5 times.
Yeah, it's like exactly.
At best,
At best,
right?
1.5 at best.
Exactly. If you're going to buy, though, let's say a laundromat that has no other laundromats in the area and nobody can compete, you're going to pay 3, 4, 5 times for that. Why? Because it's secure. The revenue doesn't change. That's what people are looking for, and that's what people want. And it's really important that they evaluate that correctly. It is not like buying real estate at all.
So what are you recommending? What businesses are you recommending? I heard laundromats. Is that
You've bought real estate adjacent businesses quite a bit in the past, right?
Yeah, I bought service-based businesses. I own technology companies, product-based companies, industry-specific and non.
Right, but even like the technology companies, like they're around improving your core business.
And that's what I think everyone needs to do. It needs to be around your core. So I understand this. I have these core things. People get in trouble when they go clear out. So, this looks interesting. And once again, they're writing trends. If you're going to buy a business, it needs to be around your core competencies of what you do or your business. Vertically integrated companies are great because all you're doing is stacking up companies within your core central practice area. It tends to be low-hanging fruit. You understand it, you get demand, and that's generally where I tell people to start. You already are doing something, look at the peripheral and find out businesses or services that you could add on. You already have built-in customers, demand, and you understand it. And so you can buy a business or start a business in that realm, and it's easy for you to predict the cash flows and understand the inputs that drive demand, drive revenue, and the inputs that drive expenses. And the more you understand that, the more you understand that cash flow, the better you'll be able to regulate it.
So an example of that would be if you're an operator, if you're a syndicator, to go buy a property management company, for example, because it's connected.
Except don't buy a property management company. That's the worst business in the world.
Well, there is a threshold that once you get big enough, it does make some sense to buy a property.
Low margin, high headache. Don't buy property.
Think about your core competencies within life. A lot of people don't look at their core competencies within their own life. Things that they're doing all the time. They're very integrated. They very know. Generally speaking, I see recession, it's so hard to say, resistant businesses as being localized. They service localized areas and they understand, and people in those local markets, they see the gaps that none of us can see or know because we don't even live there. And that's an easy way for somebody that operates and understands a market to serve a market or buy a company that you could say is being run poorly.
I want to go back and I want to just highlight, because I think what you said at the beginning was super important. Oftentimes when we think about recession-resistant businesses, that to us means on the demand side. What businesses are people going to need if we see a recession? And that is important, but as you pointed out, AJ, even recession-resistant businesses often see a reduction in demand during peak times. But regardless, I think too often we focus on the demand when we talk about recession-resistant. What businesses do we have lots of customers and high prices when there's a recession? It's one way of thinking about things, but it's not the most important way. And what you said after that was the single most important way is, what does the capital stack look like? And you talked about debt. Can you get debt? It's not just debt, it's also equity. So I'm an angel investor. I invest in tech. And what I found with a lot of my tech investments over the last 3 years was they had no problem raising $5, $10, $50 million through venture capital and angel investors back in 2020 and 2021. But the problem was those investments, those companies, when they take money through equity, when they take venture capital or angel investments, they do it with a 2-year runway, which means they specifically raise enough money that they're going to run out of that money in 2 years with the expectation that they're going to go back to the market and they're going to raise more money in 2 years. And then they'll run through that money and raise more money in 2 years. Here we are 2 years after interest rates started to go up, and nobody's giving equity. Nobody in venture capital or angel is giving money anymore. And so these companies, even though they might have the best business model on the planet, they might have the most customers on the planet, they might have the best margins on the planet, they're still running at a deficit because they're growing every month, and they're going to go out of business. They're going to go bankrupt because they just don't have money. And the same on the debt side. They're raising debt. They're raising debt from SBA or some other lender at 3-year terms or 5-year terms, and they've got the best business on the planet. But the problem is, if they get 3 years in and interest rates have gone from 4% to 7%, they're not going to be able to service a 7% debt, and they're going to go under. Businesses like Target or Walmart or whatever that raise money on bonds. I mean, 3 years ago, they were issuing bonds at 3.5%, 3.75%. Now those bonds are at 5% or 5.25%. Doesn't sound like that much. It's an extra percent or a 1.25%.
3% margin business.
It's a 2-3% margin business. And so Walmart and Target can no longer raise the debt. They're not going to go out of business. Nobody's worried about Target or Walmart going out of business. But what they're not going to do is they're not going to expand.
Yes,
they're not going to buy more warehouses. They're not going to hire more employees. They're not going to build more sites. They're not going to buy more equipment. And that's going to hurt the economy, and that's going to hurt the shareholders of those companies. So when we think about recession-proof, yes, think about demand. Always important to think about demand, but also think about that capital stack.
Yes.
Where's the money coming from? And when are you going to need more money in the future? And if the answer is, I'm never going to need more money, or I'm going to need more money so far down the road that I don't care if we have a recession for the next 3 or 5 years, that is a recession-resistant.
But you talk a lot about the tech world, but let's face it, you're big into racehorses, and that's where your real money goes, into investing in horse racing. And is that recession resistant when you invest in your horse racing?
So it's not.
Gambling's got to be recession resistant.
Yes, gambling and liquor. That's why I brought liquor before.
That's why you invest in the horses.
Well, you would think
He doesn't invest in horses. You know how you make $1 million in horses?
You start
with
with
$2 million. Yeah.
So but the reality is that with racehorses, you actually you see a decrease in the number of races, the number of opportunities to make money. Basically our income goes down during a recession. Yeah. Doesn't mean it dries up. We just consolidate into fewer races. Yep. Races that have less money because people are still gambling. But instead of betting $100 on a race, they're betting $50 a race or $10 a race or the minimum of $2 a race. So we have as many races, but those races are paying a whole lot less money. And so again, I mean, it's a recession-resistant business because we pay all cash for the horses.
Exactly.
It's not like we need
You made it recession-resistant. It doesn't mean it's recession-resistant. And that's what I got back into the fact that you can make a recession-resistant, not recession-resistant based upon the capital stack. In companies that need more money, we are in an era where money's gone and money's reducing. That's the whole point. That's what the Fed's doing, everything else. If you need to raise, if you need to get more money, hence the reason why commercial if you have to refinance or if you have to raise, you're in trouble, right? But if you already own the asset and you don't need to refinance, you don't need to raise or do anything, you're fine. Doesn't matter. Same thing.
How's our buzzwords going?
We got to wrap. I thought we'd hit on more, to be honest.
Are we gonna reveal the buzzwords?
It's tough. It's tough for me to pay attention sometimes because you guys start getting around one of the buzzwords. I'm like,
What were the buzzwords? I want to know what the buzzwords were. What were the buzzwords?
I just want to make one final point on that capital stack too. One of the best things about buying businesses as well is these SBA loans where they get 90%, right?
Yeah.
You can get a 90% loan on these SBA loans. It also makes it a lot riskier.
But you have to be careful with those because a lot of times right now, SBA loans, they're going to lock you in that interest rate for a decade, and the penalties to get out of it are horrific.
Plus, you got to check a lot of boxes on an SBA loan. SBA loan is not just like I just fill in an application and get a loan. It's like it's a pain in the ass.
It's getting easier though. You have these online business brokers and stuff where you could basically pre-approve these businesses for SBA loans. It's getting a little bit easier. It's becoming. We talked about this before, whether or not like. We started off like apartments was the shiny object, then it went into self-storage, and then it went to mobile home parks, and like is buying businesses the new shiny object? But you know these loans do make it a little bit enticing. So that's.
Are we going to do a top 5 buzzwords? Or
so we are going to. This was in lieu of the top 10.
Got it.
And so
Serena, are you paying attention?
It's time.
This was the top 5 that people came up with, and I agreed with them. I thought it was a good chance.
We only hit one of them.
We only hit one of them.
Which we knew that was going to happen.
And I thought Jay would hit quite a few.
So
of them.
what were the buzzwords?
So number 1 was Trump/Harris. So we didn't bring up either of them.
Trump.
Yeah, we got to do that for the SEO.
Is that for SEO?
Yeah.
Number 2 was transparency. So we knew because we were talking about raising capital that there was a good chance that was going to come up. Number 3 was yen carry trade. Mauricio in particular has mentioned that 4 or 5 times in the last 5 podcasts.
Yeah.
So this is an outlier podcast. We haven't talked about the yen carry trade in a while. Number 4 was due diligence.
Due diligence.
When we were talking about.
Yeah, we didn't. And we were even talking about buying businesses, and we didn't say due diligence.
We were talking about buying businesses and raising money.
We don't give a rat's ass about due diligence. Let's put it that way.
Just do it.
And the other one that people have noted is Jay usually says the word typically, and you
How did I not?
How did you did not say it?
I so expected that word was going to be on there, and I didn't even try to not say it.
might have.
I don't know. I think
in the beginning he might have, and I missed it. But then once I pulled the list up again, I'm like,
I was scared.
I didn't know that. Obviously, I didn't know.
I was scared that typically and generally we're going to be on that list, and I figured I was going to be doing shots all night.
Number 6 was Jay said something smart. That was number 6.
Yeah, we were okay.
We
never say that.
All right, that's all I got, guys. We're getting proposals for all doing shots. I don't know if we have to do that on camera though. Maybe we'll wrap this up first. We do plugs. You want to plug something?
Plugs?
Yeah, let's do plugs.
You want to plug your booth?
Yeah.
This doesn't come out till Tuesday.
Sorry. Oh, it does come out Tuesday. Okay, never mind.
Next Wednesday, right?
Next Wednesday.
The book. Just do the book. It's still on a roll. Keep plugging the book. Yeah.
Keep being a bestseller, buddy.
Exactly. Let's just keep it going.
I agree. I mean, if you keep your dash and good looks, you'll keep selling books.
That's how it sells. That's right.
I'm going to plug the book too because the book is at the bookstore. Legal Strategies for Everyone. So you can pick it up if you're here. If not, you can buy it at Amazon. Legal Strategies for Everyone.
How do you make more money if they buy it here or on Amazon? Which one?
I make a lot more money if you buy it here.
Okay, there you go.
You make money.
Help out Mauricio. Because he needs it, obviously. Look at him. Like he's wearing a free T-shirt.
I'm like wearing a free T-shirt with like tiramisu spilled all over it.
What do you got?
I'm going to plug the Limitless Conference. I'm guessing by the time this comes out, next year's conference is going to be open for registration. Maybe not. I don't know. But
it's very nice of you, Jay.
This is amazing. This is an amazing conference.
It is.
They got us up on the stage last minute. They made us a placard. Got some amazing people out here.
We got to take that home. We got to frame it or something.
We're definitely taking that home. So if you weren't able to attend Limitless this year, absolutely come to Limitless next year.
And I mentioned before, you can actually get the videos. So all 3 of these guys, I think you're speaking.
And by the way, if
times,
you guys are still hanging around here, it's like midnight, whatever time it is right now. We have some. Don't tell us, Sarah. I don't know if Sarah's here. We've got some booze back here if you guys want some.
Quite a bit of booze.
Come help yourself. Seriously, come on, help yourself.
All right.
And what do you plug in? Are you going to plug your wife?
Well, I love plugging my wife. It's one of my favorite things to do.
Yeah.
But I'm going to plug next Tuesday, since we aren't recording a podcast
that's
because
right.
of this.
Yeah.
We are going to do a live stream of our fantasy football draft.
Yeah.
I'm excited to see AJ on that fantasy football draft.
Oh, you're gonna-
and see
trust
his
me.
into the
They're going to
football.
blow you away.
Oh, yeah, I'm excited.
Of course, by the time this comes out, that will have been yesterday.
Oh shit! Yeah, that's right.
Oh,
I didn't really think that through. All right,
Plug your wife. Just plug your
I'll
wife.
just plug my wife. I'll just keep plugging my wife. Badass investor. Go check her out. Do I got to chug this so I can say this drink is
Yeah,
gone?
you gotta
We're
chug
gonna
that.
chug this. We finish our drinks.
good job, guys.
Our first episode all together in the same room, everyone. Woo! Thank you for sticking around. Really, really appreciate all
really
of you. Thank
appreciate
you.
it. Thank you.
Thank you very much.
My drink is gone. I'm gonna go hit the head. I will see you next Tuesday.
See you next Tuesday.
See ya.